Despite commanding an 80% market share in advanced tech nodes and growing at 20% CAGR over the next 3 years, TSMC is being misunderstood by the market, and its forward free cash flow multiple is trading at a 7% discount to its 5-year historical average, presenting an attractive entry point. With a margin of safety and stable 25% ROE, TSMC offers a compelling opportunity to earn a 27% upside at a 2.3 times risk reward ratio. TSMC offers a 67% of the $129 billion pure play foundry market. In the 70 billion leading edge nodes below 7 nanometer, TSMC has 80% market share. Samsung, the distant second player, has just 8%. Even when one includes the manufacturing of its chip products, the Korean player only has 15%. The gap between them will widen due to TSMC's structural advantage as the sole independent producer, thereby perpetuating its moat, as TSMC holds 100% of industry's profits. TSMC's bears, via first order thinking, speculate that DeepSeek's model upends hyperscalers' approach to spending massive capital expenditures to obtain as many NVIDIA GPUs as possible, thereby gaining an edge in AI. I beg to differ. As Nadella accurately wrote, Jevons paradox strikes again, with DeepSeek's efficient and cheaper model. AI has become increasingly accessible, driving greater adoption across various industries. This AI efficiency, therefore, doesn't reduce chip demand. It rather expands the AI market by resulting in more AI computation and accelerating demand for TSMC's chips. The fact that other cloud service providers have also increased their capital expenditure plans for server hardware in 2025 strengthens my conviction that TSMC's AI growth runway is long. Thus, I've modeled AI accelerators to contribute from 14% of TSMC's 2024 revenue to 42% of its 2029 revenue. With Intel's new CEO, speculation that TSMC will share its process know-how with Intel and acquire Intel fabs should no longer be a concern. Baird has speculated that TSMC will send its engineers to Intel to share its expertise on nanometer 3 and nanometer 2 processes. The press has also reported that TSMC has pitched Intel Foundry joint venture to NVIDIA, AMD, and Broadcom. If these events were to unfold, TSMC would eventually be diluting its power and potentially taking over Intel Foundry, which posted a $12 billion operating loss in 2024. These are legitimate reasons for TSMC's stock to underperform relative to the market year to date. However, with the appointment of new Intel CEO, who hinted at in a letter to his employees by vowing to make Intel a top foundry, these negative overhangs should no longer loom over TSMC. Besides, both NVIDIA and a TSMC board member recently confirmed that neither had discussed the potential tie-up with Intel for its foundry business. Taiwanese officials have also made it clear that they're going to prevent tech leakages by keeping the most advanced tech nodes production within their borders. Unlike the market, I believe TAN can change the tide. Intel jumped 15%, and TSMC dropped 3% as investors cheered, hoping that the appointment of Tan will reinvigorate the competition between the two foundries. They point to Cadence's 391% stock returns during his previous tenure as if he could do the same at Intel. However, investors fail to recognize that its direct competitor, Synopsys stock, performed similarly at 358% during the same time. I would also argue that Intel's structural headwinds are a lot worse than that of Synopsys. Intel isn't profitable enough to undercut TSMC. Intel's gross margin is 34% versus TSMC's 56%. Nor can it outspend to catch up with TSMC's tech lead sustainably. For instance, if you look at 2024 numbers, TSMC used 91% of its free cash flow to fund its capex and R&D. Meanwhile, Intel generated $13 billion in negative free cash flows, and despite spending about 2.5 times on R&D, more than what TSMC has spent, Intel's tech capabilities were so behind such that it has been outsourcing a significant portion of its advanced tech nodes to TSMC. My estimate also indicates that Intel contributes 8% of TSMC's 2024 sales and is expected to continue doing so for 2026 sales. Trump's threat to impose tariffs on semiconductor exports and letting the CHIPS Act expire will likely persist. But what will also withstand uncertainties are TSMC's structural competitive advantages. Although I acknowledge that TSMC's recent pledge to invest $165 billion in the US was primarily intended to gain validation from Trump, and these fears should therefore recede, I also wanted to conservatively bake in the slight possibility of the US president still letting the investment tax credits provision expire and him using tariffs for a short period as his negotiation tool. However, even in this draconian scenario, TSMC can exert its pricing power by passing on all duties and high capex spending to its consumers. Indeed, it will face volume decline due to cost inflation, but it's best positioned to withstand macroeconomic headwinds compared to its peers, which have inferior cost structures, are more reliant on CHIPS Act subsidies, and are more impacted by Trump's tariffs. DCF is impractical for a cyclical manufacturing company like TSMC, and the PE multiple ratio overlooks capital expenditures and depreciation. Thus, I use the forward free cash flow multiple to value TSMC, as it reveals its true cash profitability after accounting for necessary reinvestment. I believe gross margin is the best leading indicator of what the forward next 12 months free cash flow multiple should be in relation to its historical average. For instance, TSMC's 5-year historical gross margin is 55%. Since my 2026 gross margin estimate is 60%, which is about a 9% premium to the 5-year historical average, I applied a 9% premium to the 5-year forward free cash flow historical average multiple of 12.1 times to derive a 13.2 times base multiple.